Hi, I'm Chuck Gibson with you today to introduce Taking Stock with Art Jarvis, a new feature here on Loveland Beacon. Art Jarvis is founder and president of Jarvis Global Investments, a family-owned and operated investment advisory firm based here in Sims Township, offering private portfolio management and retirement services for high net worth individuals. Jarvis Global Investments is a fiduciary with a duty to always place the client's interest first. Along with his active involvement in the Loveland community, including his service as a former president of the Loveland Schools Board of Education and member of the Board of Directors for Little Miami River Chamber Alliance, Art Jarvis brings a wealth of financial knowledge with over 30 years of investment experience, including more than 15 years managing his own firm. He holds a master's degree of business finance from Xavier University's Williams College of Business. He is uniquely qualified to help us all take stock of our personal investments and the economic trends impacting each one of us. I'm pleased now to welcome Art Jarvis for the first edition of Taking Stock. So we welcome Art Jarvis to Loveland Beacon. Art Jarvis of Jarvis Global Investments, beginning a new series here on Loveland Beacon talking about, well, I think we're going to call it, you got the name.
Taking Stock.
Taking Stock with Art Jarvis. So starting a new series of Taking Stock with Art Jarvis. Today, though, as opposed to focusing on some specific things with investments and the financial status all around us, you know, what's happening with the economy, we're going to touch on all of those things. And then as we go forward in other episodes, we'll talk about some specific things. But, I mean, what are the things, you know, in today's economic or financial environment that are kind of important to talk about right now for people who might be investing or trying to protect their, you know, retirement future?
Right. Yeah. I mean, there's actually a lot going on right now. There's unfortunately a lot of negativity out there. You know, we're still trying to walk ourselves back from a global pandemic and the things that we did to try and quote help the global pandemic. You know, inflation and unemployment and lower earnings and a declining economies and things like that. So, you know, there's those after effects and us still trying to back those things down again. You know, right now the biggie is the debt ceiling. You know, our leaders up in Washington are trying to compromise and come up with something they can all agree to raise the debt ceiling and keep us from having to shut down the government for a period of time. And really the big discussion going on is everybody's worried about us defaulting on our debt because of not doing that. So that's the biggie right now.
Right. Well, and, you know, and on that note, and we're going to allow you to talk about a whole bunch more that surrounds the economy right now, but on that debt ceiling, the impact of, let's say, failing to come up with an agreement between the powers that be in D.C., what does that mean to you and me and everybody else, you know, in our financial situation?
Well, I'll go with what normal is. You know, I mean, I've been doing this for 36 years, and we have had probably, I don't know, 20 times where we've had to deal with the debt ceiling. And most of the time what happens is they will take it down to the 11th hour, and they make an agreement, and everything's all hunky-dory. But other times they actually end up shutting down the government, which means people, you know, go on furlough or whatever you want to call that, but they end up getting a paycheck, a retroactive paycheck and those usually only last a week or 2 or 3 weeks. I think we pushed it to a month one time several years ago. But that impact, that uncertainty, really it's greed and uncertainty, fear, uncertainty is what drives the market. So the debt ceiling is another level of uncertainty that's being added to the market, which theoretically most times will cause the market to go down some. The good news is usually they come up with an agreement on the debt ceiling, and the market usually kind of pops back up to where it was in the first place, and we get back to business. The problem this time around is there's a whole lot of discussion about us defaulting on our debt. And I guess the best way to put it is the U.S. is considered the risk-free investment, the risk-free rate from a global standpoint. So if I'm looking at, I want to know the risk-free rate for a 10-year, I say, okay, let's say the risk-free rate is, 5%. Well, that if you, all of a sudden the United States is defaulting on their debt, that causes a lot of chaos. So the things that are what we consider the given, like, in college, U.S., the risk-free rate, this is how you do these calculations and things. If all of a sudden that given is no longer the given, it has a huge impact on the global financial markets.
Defaulting on the debt is, when you talk about like fear-driven,
yep,
that's a fear. Me sitting across from you having this conversation about where we're at, and the U.S. defaulting on debt means, a great deal of fear, because I don't know. So what just like in one example, what happens if the U.S. defaults on debt? What's a scenario that you can see?
Automatically, our interest rates will go up because our debt is more expensive than what it was before. We're not the risk-free rate anymore, so that default risk becomes a higher number. So I couldn't even tell you what it would rise to, but let's say the 10-year Treasury bond goes from 5% to 6%. Well, just that 1% would wreak havoc on the global economy. It changes all your calculations. It changes your weighted average cost of capital for if you're planning, expansions and things like that as a company. It's our cost for our debt, which is about $32 trillion right now. That our cost of debt now goes up and things like that. But even more importantly, the way the rest of the world looks at us changes. I'm talking a lot. Clients have been asking a lot about it lately, and my response to them is, I would truly hope that they're not that stupid. Because
that was going to be my question. Is so as an advisor, what does it mean to you in terms of response to questions from investors like me that are saying, "Hey, Art, what do I do? What do we do?" And so your expectation, I guess most of us, it's like, forget the fear for a minute. Let's sit back and say, history has shown us, is what you're saying. History has shown us that it's that 11th hour. They'll come to some sort of agreement, and we should probably expect the U.S. not to default.
Yes, correct.
So, at the end of the day, that's the... And that's the other part of the comment where, let's hope they're not that stupid.
I hate to use the word stupid, right, but it's probably a very fitting word for it. Janet Yellen, who is with the Treasury Department, she made the comment that you're talking about absolute chaos, I believe is almost a quote from her, and she's not wrong.
So she knows, but that's the point. She knows.
Oh, yeah, she's been very vocal about it. Very vocal. So, it's not like it's not out, which is the clients are seeing all that and everything. But yeah, you're right. There's some things we could do in the portfolio to kind of protect things, to hedge our bets a little bit. But, at the same time, if you're a younger client or something like that, my advice is just to ride it out. We might have a little bit of negativity. The market might drop a little bit. Them changing the entire global financial landscape, I just don't think is an option. And I have to believe that everybody knows that.
I'm going with that. I'm going with that belief too. And again, history, as you said, history has shown us, certainly in your lifetime and my lifetime, that this situation arises with the debt ceiling, and an agreement is, usually reached. So we're going to hope for that. I'm going to steal a line from you at the beginning of this. Because I'm going to walk you back. As we're trying to walk the economy back to pre-COVID or back to a level thing. What does that mean, again, because you're talking about the global pandemic that had an impact. Not to mention that in the midst of the global pandemic, we had a change in administrations in terms of the federal government and who's running the country. So when you say walking it back, what are some of the things that you do, again, as an investor, or what are you advising your clients to do to protect their financial future in terms of trying to walk it back forward.
Sure, right. I mean, and just real quick history. I mean, if you go right before 2020, we had an economy that was growing over 3% per year. We had unemployment that was close to the 3% level. It was 3.1. We had fantastic earnings numbers. Inflation was very, very low. Not non-existent, but not really a factor, to be honest. 2020 hits, and literally in a period of a month or so, we lost 35-40% of our economy. We lost 35%. The indexes for our stock market dropped 35 to 45%, depending on which index you're looking at. Unemployment shot up to 20%, and actually I pretty much think that number was actually higher. I just don't think they were able to calculate it that easily. So things changed drastically, and now when I say walking back, I mean, our response to that basically was to pump $6 or $7 trillion into the market, which clearly became hyperinflationary. Next thing you know, we're looking at 9 or almost 10% inflation, and we have spent really the last year and a half trying to walk back from that. So from a client standpoint, number one, you're trying to protect the portfolios. There weren't a whole lot of options a year and a half ago because, a money market fund was paying about 0.5%, which is better than losing 20%. Don't get me wrong, but it's been so you're like, okay, I could be here or I can be in cash, which is only going to give me 0.5%. Kind of the silver lining to things right now is we have raised interest rates 10 times or something like that over the last year. We've raised them 5%. Well, the interesting thing now is if I really want to protect clients, we can go and buy a money market fund or get into it. It's paying almost 5%.
Right.
So, before where the alternative was I could be making 8% here or I could be making 0.5%. Now the alternative is okay, maybe I'm making 7 or 8%, but my alternative is 5%, which is a much more reasonable alternative. So hopefully I'm answering your question. It's just, we have more options now, what we can do for clients and things like that.
Yeah, I think that, going back, because we talked back during the pandemic and offered some tips, to people so that they didn't get caught up in the fear of the unknown, what's happening to the economy. So going back to that a little bit, and it's kind of the same thing, I think. I don't know, you're the expert, but you got to tell the clients to, as you said, those younger ones especially, ride it out.
Sure.
But in terms of looking at my investment or looking at my portfolio, should I make quick moves, or what do you tell your clients in terms of looking at the portfolio and adjusting? Should people say, hey, I need to get out of stocks and get more in the other money market things, or do you say, hey, subtle adjustments, or let's just review? What's the best advice for people in general?
I like the term subtle adjustments because when we set up a portfolio for clients, we're setting it up based on certain parameters. What's their time frame? What's their liquidity needs? What's their risk tolerances and things like that? Those things normally haven't changed, right? They still have the same risk tolerance. They still have the same time frame. They're still going to need the same amount of money. So you can tweak things a little bit, but you still kind of want to stay with the game plan that you have. The reason is, you want to stick with the game plan, but it's, the reason we came up with that game plan for whatever client it is that, it's based on historical things. And I know that the stock market's going to give you 9 or 10% per year on average, right? So if you go back into history, in spite of a great recession, in spite of a dot-com bubble, in spite of 9/11, in spite of
mortgage housing,
oil and China and Brexit and all these things that have been picked, the net of it is, in spite of even of those really bad times or those rough times, you still end up making 9 or 10% per year in the U.S. stock market, okay? Still believe that's true. I don't believe anything has changed to change that. We're just right now, we're down in the bottom of the trough. And, you mentioned earlier in the question, it's like, if you're younger, that's a lot easier to stomach. If you're at retirement or getting close to retirement, that becomes less easy to stomach. But also, hopefully, as we're getting closer to retirement, we also began to become more conservative. Okay, so we started making subtle changes in the portfolio to start adjusting for that. So
as we call these visits with Art Jarvis and Jarvis Global Investments, taking stock. So that's the advice for right now for any individuals taking stock of what your situation is, all those different parameters that you talk about, liquidity, age, timing, and what your goals are. And so that's what we're going to do when we get together again. And Art, listen, thank you so much for taking the time to share your insights today, and we'll look forward to taking stock next episode.
Fantastic. I appreciate you having me. Thank you.
Thanks.